Welcome, Torsten.
Thanks so much.
So Torsten has a very busy life, so I'm just honored that he could, and we are honored that he could join us, and he was very graciously.
Well, thanks for having me.
So, chief economist at Apollo Global, and when we were chatting, usually people think about economists as sitting, at least in academia, we sit in back rooms, we run estimations and regression equations, and you come up with these models, and of course that will do very well in the age of machine learning. But and I know you spend a lot of time talking to people both on the investment teams at Apollo and also sort of the companies that want to hear sort of your insights and wisdom. So tell us a little bit more about what your role is at Apollo.
Yeah, so I joined 3 years ago, and what I do at Apollo is I spend half of my time internally, including talking to our portfolio companies. We have about 50 portfolio companies. And we talk about a lot of different things, including how to implement AI in a lot of the processes. They are across all sectors of the S&P 500. They really cover all areas of the economy and trying to figure out what are they doing, what can they do better, what are the results, what overall is the business framework, in particular with the backdrop of a digitized economy. So half of the time is listening to them, talking to them about what's going on. The other half of my time, I talk to investors in our funds. We have about $600 billion AUM. And we talk about, is inflation going up? Are interest rates going down? Is the dollar going up? Are wages going up? All the macroeconomic issues that are very important from an investing perspective. So it's a very broad job that I have that both focuses on internal things, because we have portfolio companies, we make investment decisions every day, and also external from a fundraising perspective. Also, I talk to the media, CNBC, Bloomberg, New York Times, basically about where is the economy going, interest rates going to stay high. All those things are basically coming from the economics perch.
So, well, you just gave me my next question. My head was swimming as you were talking, actually, because I was reading the financial news before I came here, knowing I was going to ask you questions about, literally like 2 hours ago, I was looking at the Financial Times, and it was interesting because, stocks have had the worst month in September. The Fed announced that interest rates are going to be kept high, which was obviously bearish for both stocks and bonds. And then as I was driving here, I drove past my regular gas station. And I've been in California a long time, and it was $7.10 for premium gasoline.
Wow.
And I have never, ever in my life seen gasoline over $7 a gallon. Now, admittedly, it's a little expensive in California because of our environmental requirements and so on. But still, how do you sort of, what do you think about all of this? How do we put some order on all of this?
There are a lot of things going on, but I think that the first domino brick and the most important thing to remember is that the reason why we are in this situation here is because we have had and still have high inflation. And why did we have high inflation? Well, there were two important reasons for that. The first important reason was that when we were sitting at home during the pandemic and ordering stuff on Amazon and online, we basically couldn't get it delivered. And we had so much more demand for new sofas, new computers, new printers, new everything, that goods prices and therefore inflation of a lot of things really went up a lot, simply because we had a lot more demand, and simply also because China and Mexico and emerging markets and many manufacturing facilities in the US, they couldn't deliver. Mm-hmm. So we had an imbalance between we had much more demand and very little supply, and that's the recipe on page 1 for getting more inflation. So that's the first reason why we got inflation, and we are working through the supply chains now, as some of us were talking about just before we walked in here. And the supply chain situation does look better, but there's still the case that inflation is still somewhat elevated, simply because of this left hangover, that we still have some issues with getting stuff into the US, and we still have relatively strong demand for goods. So that means overall, goods inflation continue to go up. The second reason why inflation is high is that during the pandemic, we saved a lot of money because we were not flying on airplanes. We're not staying at hotels. We're not going to Taylor Swift concerts. We're not going to the US Open in tennis in New York City because it was just not happening. So as a result of that, the household sector in the US saved a lot of money. And because of that, now that we are out of the woods, we can now go to those things, Taylor Swift concerts, we can fly in airplanes, we can have conferences, we can see each other finally again. And because of that, we have very, very strong demand, in particular for services. And services makes up 80% of GDP. Mm-hmm. So if I combine those two things, that not only could we not get goods, and that's why inflation was high, but now if you look at, for example, the airline industry is doing incredibly well. Hotels are doing really well. Restaurants are doing really well. because there was still so much savings that we are now working through that was spent on services. And again, that makes up 80% of the economy. That meant that we both had inflation because supply chains weren't working, and we also now have inflation because we're now going much more to restaurants and going to shows and concerts and sporting events. I mean, if you buy any sport ticket at the moment, it's still really expensive. So we're working through our savings, we're working through the supply chains. So the short answer to your question is, we are still not quite there yet.
Yep.
And that's why the Fed and Jay Powell keep saying, we got to have interest rates high for at least a while longer. And that's unfortunate for venture capital, unfortunate for anyone who needs to refinance anything, because we still need those domino breaks to completely settle at a lower level where we get inflation back to where we were before. So this was a very long economist answer to your question.
I'm an applied economist too.
We had some tailwinds to inflation. Those tailwinds are now abating. So inflation will be coming down. That's the Fed's projection. That's the consensus projection. That's our projection. But we're just not quite there yet. And that's why financing conditions and interest rates are still high for at least another 6 to 12 months.
And I just read literally also today when I was scanning the news that Taylor Swift resulted in a $330 million value add to the LA economy.
Yep.
So one person. So I wonder how much of that service spend actually goes to her. Anyway.
And you saw that on Ticketmaster now, you'll be taxed if you were reselling tickets and if you were scalping. So
it's pretty impressive that she managed to crash the Ticketmaster system, or maybe that's not so impressive. I'm not sure about Ticketmaster myself. Don't record that part of it. Let's broaden that. So I get the sort of the economics, sort of all the things that we traditionally look at, but then we've got the war in Ukraine. You know, we've got labor strikes. We have the potential of a government shutdown. Hopefully they will avert it, but right now they haven't reached a deal yet, at least when I left home. How do you add all of these geopolitical factors, and there's still tension with China. Pandemic is gone, but COVID is still around. Like, how do you add all of this into the mix?
I know, and well, everyone in the room here will appreciate that, but the Fed has a model of the US economy, and I know this sounds a little bit peculiar, but they do have a model of the US economy, which is essentially 250 equations, which try to determine our behavior as a function of all these things. And you can try in those simple OLS regressions to change the residuals and say, what happens if I raise interest rates by 5 percentage points? What happens if I introduce some uncertainty about geopolitical risk? So we can then discuss how you quantify that specific risk. But you can basically try to run different simulations in the Fed's own model of what happens to the US economy, in particular if interest rates go up, in particular if you have a strike, in particular if you have a government shutdown. And then you can try to figure out what does that mean for your projection of GDP over time. And the answer to that is that there's no surprise that the stock market is getting a bit upset here because you have so many unquantifiable risks. We don't know how long time a shutdown might take. We don't know how long time a strike might take. We don't know how long time issues might be in Ukraine, Russia. We don't know how long time before China's slowdown starts to reverse. There's just so many unknowns at the moment. We know what they are, so they're so-called known unknowns, but we just have such a hard time quantifying them. So that's why financial markets are pulling back, in particular combined with this risk that interest rates are going to stay high, because Jay Powell, despite everything you just listed, he came to the press podium here now 2 weeks ago and said, we are still going to keep interest rates high.
Right.
And that means anyone in venture capital, anyone in finance are going to say, well, if I can get 5, 6, 7% in financial markets, in particular in the Fed funds rate overnight, well, why would I begin to take so much risk? If I come with a good app and say, I have a good idea, do you want to finance it? But I will only start making money after 4 years. Well, you would then say, well, after 4 years, if interest rates are 5%, I will have made 20%. Even before you start making money on your app.
Right.
So that's why it is a tough fight at the moment for anyone with a good idea, simply because you are fighting risk-free rates that are so high by historical standards that is a particular key driver of why financial markets at the moment are really pulling back significantly.
Would you say they're good inflation-adjusted rates? And
So with inflation coming down, then we will get the real interest rates will be higher. So that means that the Fed is going and interest rates are going to stay elevated. You've seen long-term interest rates go up quite a lot. So if inflation does start to come down, you will have inflation-adjusted interest rates that are beginning to look more attractive. But obviously, all this rests on the assumption that inflation is coming down and we have a soft landing, everything settles beautifully. And it also is therefore on the assumption that the Fed will subsequently begin to lower interest rates.
Yeah, so the Bank of America CEO also said he's expecting, everybody seems to be saying that they're expecting a soft landing. Not everybody, there are some people who
Jay Powell says that the goal is a soft landing. And then we all say, well, we hope we'll get that, but we may not get it.
Well, what is a soft landing to you?
So a soft landing means the Fed has a dual mandate of inflation and full employment. And if we get both inflation coming back to 2%, remember inflation peaked at 9%. If we get that back to 2%, which is what the Fed is forecasting only in 2025, and if we also get that the economy, meaning employment, at the moment the unemployment rate is basically at the lowest level in 50 years.
Yep.
That's why it's been so hard for all of us to find workers and find colleagues to work with, because wage growth is still very elevated. So the answer to a soft landing would be inflation gradually coming down and the labor market coming back. So a more practical way of talking about that is that we are already today, because of high interest rates, seeing a lot of people fall behind on their credit card debt, on their auto loans. We're seeing default rates for high yield go up quite quickly. So the Fed probably looks at this and says, well, maybe we should just begin to slow a little bit with our rate hikes, because interest rates are already biting on consumers. It's already biting on companies. So it's not only in venture capital and Silicon Valley here where we're seeing the effects of high interest rates. It really is having a very profound impact on consumers and on firms. And that's why ultimately we should get both inflation to come down, and we should also get the economy more broadly and employment to come down. But the last statistic here is the consensus still expects a 60% chance of a hard landing, of a recession. So that gives you a little bit of a worry that maybe this process of controlling the supertanker of the US economy, it's easier for me here to wave my arms and say, oh, it's all just got to come down. But the problem is if consumers overnight begin to say, gee, interest rates are really high, I'm not buying a new car, I'm not buying a new sofa, I'm not buying a new iPhone, I'm not buying a new washer dryer, that could run the risk that consumption could fall, and therefore we could have the bigger risk that we get a harder landing.
So soft but bumpy?
Soft but bumpy is probably the best prediction here.
Please know you heard it here first. Vijay actually made his first economic prediction
in
his
12
life.
months and we'll see where we are.
Exactly. So what is Apollo or your prediction for, like, if the Bank of America CEO says soft landing, what do you say?
Well, because we have 600 billion assets under management, we are more conservative and say we are trying to protect ourselves against the risk of that hard landing, which has a 60% chance. So we are very conservative. In our language, we are up in quality in the firms that we deal with. You are much at risk if you deal with small cap and companies that are heavily levered and have interest coverage ratios. Remember, interest coverage ratios measures interest expenses relative to earnings. If you have high interest expenses relative to your earnings, then you're also more challenged in this high interest rate environment. Because the answer to your question really is that when you have interest rates are going up and earnings are going down, you have to be more conservative and you have to be large cap companies, companies that certainly also will survive even if there's a recession, companies that have good finances, meaning are not sensitive to high interest rates. And that generally in financial terms means you want to be in investment grade credit and investment grade companies rather than being high yield and more vulnerable companies, because the more vulnerable companies will be suffering more if interest rates stay higher for longer. And in fact, if someone from the Fed were sitting here in the audience, they would say, but the whole idea with raising interest rates is to have people buy fewer cars, is to have us spend less money on our credit cards, is to have companies hire fewer people. So in that sense, we should not be surprised that that's exactly what's happening. Namely, we are seeing a slowdown in hiring, we are seeing fewer cars sold, we are generally speaking also seeing consumption slowing down. The only thing is that we still have this savings that I mentioned earlier that is still providing support for Taylor Swift tickets and other things. But broadly speaking, we are moving in the direction of the economy slowing, and we all hope that it will be a soft landing, but we are preparing ourselves for the risk that we might have a bit more bumpy road ahead of us.
You know, it's funny, I've been in the US for over 40 years now, and this is the first I'm actually having a conversation where we say that the savings rate is actually pretty high.
I know,
because it's usually been we spend too much, but this is the pandemic-induced, I would assume.
There's an ongoing saying in the economic circles that don't bet against the U.S. consumers spending money that they don't have. So it is certainly because it is so easy to get a credit card, it's so easy to borrow, and that has been supporting the U.S. economy for so many years. But at the moment, the interest rates at these levels, it might finally begin to bite harder, including on the consumer.
No, and it's already showing up, as you said, in delinquencies, which have definitely, we are doing a research paper on that, and we track them, and clearly they've been going up. Most of the people in this audience represent big corporates. And so how does this affect what you're talking about? Technology is now $600 billion a year in capital investment in software alone. I'm not even talking about hardware. You've got companies like Microsoft spending 10.x billion last quarter in the CapEx for These are big numbers, right? It's the highest ever apparently for Microsoft.
Absolutely.
And so what do we say to the companies in the room who have capital-intensive businesses, or even if they don't have capital-intensive businesses, are now going into an AI world, which is capital-intensive, at least for the learning part of training the models?
Yeah, so there's exactly, and this is the way I look at the theme for the conference more generally, is that there is a business cycle where the cost of borrowing are very, very high. But that may not hold me back if I have a structural good argument for investing in AI. So the debate here in many CFO and CEO offices at the moment is that, yes, if we can finance this, if we have the money ourselves, if we have some organic earnings, or if we have another way of doing this without borrowing, without having to depend on high interest rates, this is actually a great environment because this is a structural tailwind to a really good idea, namely that AI can change things in so many different ways, both internally and also externally. So I would view the answer to that question as a function of, if you're heavily dependent on financing, then it becomes more risky to borrow simply because we just happen to have AI dumping down at a time when the cost of capital is very elevated. In my view, AI could have come around 12 months ago or in 12 months ahead, and then we would have a very different financing environment. So the fact that this is happening in a financing environment where interest rates are literally at the highest level they have been in decades is just complicating this discussion about should we do it, should we not do it? Well, if you don't depend on financing, well, then you should certainly go ahead and do it. But if you do depend on financing, you do need to take your spreadsheet out and figure out, can I create the returns that can outcompete the risk-free rate? So it really is page 1 in your finance textbook from a business school perspective in terms of, well, whether you do something from a CapEx spending perspective really depends on, can I do better than the risk-free rate? So therefore, I think there's a strong tailwind to everything in CapEx and across everything in AI and across all variants of AI. But the risk is that it's competing more and more and more with a risk-free rate that is just looking, unfortunately, more and more juicy from an investor perspective, but more and more prohibitive from an investing perspective.
There's a very high percentage of people who are now invested in basically money market funds and things like that.
That's more than 5 trillion has gone up, several trillion since the Fed started raising rates.
But I want to go back to this AI thing that you spoke about, because I think from our perspective as economists of technology look at AI, I think we acknowledge that the payoff from AI is some years away. I mean, there's very few applications where you're going to get a massive ROI in a year or two. But the flip side of that is if you don't invest now, you can fall behind companies that do invest. And in some cases, you may never catch up. I mean, you saw that Amazon made a $4 billion investment in Anthropic yesterday or the day before, right? Because they're clearly behind Microsoft and OpenAI. So there's a early mover advantage to this thing. And so I think that complicates the conversation a lot. And there's a lot of people in this room who I won't mention the names of their companies. The companies believe in AI, but getting money for AI is still pretty difficult, even though the belief exists.
Yeah, so even if interest rates are high, you need to have some assumptions about the productivity gains that you get being potentially high. So you're sort of battling on several different fronts. We have been used to interest rates being zero for basically 15 years in a row, but that's now changing the equation. Even if I think that I have very steep increases in productivity as a result of AI, they are now again competing with the fact that interest rates and therefore the cost of borrowing are at these elevated levels.
When you invest, this is asking a question about the investment side of your company. Are you looking and evaluating the sort of the digital capabilities of the companies you invest in?
Absolutely, this is very critical because a very important part of our overall strategy is to turn companies around, help them operationally get better. And with that process is a very important ingredient, thinking about what is the technology that we can deploy to make this company more effective. Ultimately, we're all looking for productivity gains. And to be sure, AI will create significant productivity gains. Estimates are suggesting it could, over the next 10 years, generate 0.5 percentage point of GDP every single year. And that may not sound like a lot. Remember, GDP normally grows 2%. So if you add 0.5% to that, that is very meaningful. So there are certainly a lot of gains, both at the macro and at the micro level. But it is a very important ingredient in thinking about how do we turn things around, how do we invest in companies and make them more productive. And a very important part of that discussion at the moment is indeed what is the technology changes that we can make. And those things are difficult discussions. Sometimes, as you said, we say, well, we want to do this, but it's maybe a little bit more expensive. Let's try to take a baby step first here. Sometimes we go for the Hail Mary and say, let's try to go all in and say this can be a game changer if we get this right. And the first mover advantage no matter what interest rates are doing, is certainly a very important ingredient also in that discussion.
So the dynamics are important. Let's turn now to social responsibility. But the planet is under, whatever your personal position might be, the planet is under, stress like we've never seen. Those of us who live in Southern California have seen weather patterns that are really unusual for us. When Palm Springs gets flooded, which is a desert, it really sort of wakes you up. And then, how do you think about sort of the ESG because clearly that it's no longer sort of a straightforward risk-return calculation. I mean, there is essentially one, but then you have to build in all these additional variables.
And that is, of course, a very, as we all agree, a very important component of investing. And we have it built in as a process, both the E and the S and the G. We're thinking a lot across every investment we do. We have a process where the environmentally consequences and environmental implications are assessed. We have the social consequences, and we have the governance consequences. So everything is assessed as a part of the process. It's fully integrated now as in the decision making on the investment committee. So in that sense, it has just become natural for us to talk about the E and the S and the G. It is, of course, adding some complications compared to how things were done 20 years ago, but it is nevertheless something that in many cases actually also generates both productivity gains and gives a holistic view of the investment decision. So it's no longer, quote unquote, just looking at what is the return from a very simple spreadsheet perspective, but looking at it from what are the overall dimensions, the holistic view of what is the right thing to do and what is the thing that's best to do for this company in terms of the overall performance.
I want to drill down a little bit deeper on the G part of it, which is actually a CG because it's corporate governance. What's your assessment of sort of the corporate governance when it comes to things like ESG and ES, I guess, and also sort of on the digital side? Because in this world, our digital leader community, we often see sort of boards not savvy enough yet to address many of the risks, the opportunities and the risk. How do you think about corporate governance these days?
Yeah, no, well, that is extremely important. And I think a very difficult part of this discussion is exactly that digitization and making things more efficient could exactly be part both of the E and the S and the G.
Yes.
So in that sense, a very important part of the process of figuring out how do we, for example, if you just think about the E, well, you need a lot of data to figure out what are the environmental consequences, what's the environmental impact, both on the inputs and on the outputs and the whole process. And that requires data analytics and figuring out how is this done, how should it be done, where do we want to be. Likewise, on governance, exactly, digital transformations are a very critical part also of figuring out what is the governance of this company, both on the internal side, both on the external, and also everything that's going on around it. And therefore, it's just complicating the debate much more relative to how things were done earlier. But that is a very important part of really turning every single stone. So it has become more naturally a part of the due diligence process of figuring out what is the right thing to do. How do we want to get this company from where it is today to where it should be in 5 years' time?
Let's shift to geopolitical risk. And we can talk about lots of countries, but let's focus today on China and India. Because at this conference last year, Jagdeep, who was the head of UC Investments, was talking about how he has pulled most of his funds out of China and was investing in India. China is still, there's a lot of concern, I guess. And in the technology world, it's pretty hard to handle because we spent years integrating our ERP systems with our Chinese operations, for example, but now we're being asked to disassociate from them. India is a new set of challenges recently, but also a weak infrastructure that they're trying to catch up. How do you see investment opportunities and what should we be thinking about these two countries from an investment perspective?
No, this is absolutely critical. So from a macroeconomic perspective, so let's talk about the macroeconomics first, and then we can talk exactly about what are the other special issues with China in particular at the moment. There's some very important differences, as you know much better than me, between what's going on with China and India at the moment. But China specifically is having some cyclical problems because if the US is trying to slow growth down and Europe is trying to slow growth down, that's hurting Chinese exports. And Chinese exports are falling 15% year over year at the moment. That's the fastest rate in decades. And when Chinese exports go down, that means that Chinese manufacturing and the Chinese economy generally is on a cyclical downward pressure simply because the rest of the world is slowing down. Otherwise, on the macro front, we also have that they have some problems with demographics are not particularly favorable at the moment. The one-child policy created a significant demographic hurdle that is now also creating some problems in terms of simply the workforce shrinking quite significantly over the next 2 decades. That's already showing up. That started in 2000, and that's already showing up as we speak here in the next 5 years. We'll continue to see the workforce shrinking, and that's a major cyclical and structural problem. And then finally, we also have a little bit special issue, but the Chinese housing market is unfortunately also quite challenged on the macro front, simply because, remember, households in China are not allowed to invest in stocks outside of China. So that means that the main asset that households have is that 70% of assets on the household balance sheet is housing. And that means that a lot of Chinese households, they own 10, 20 apartments. And now that home prices have been going down 5% over the last 3 years, that's beginning to create all kinds of problems, namely that household assets are then under pressure, the banks who gave the loans are under pressure, the builders are under pressure, and the trusts who gave you a return between 5 and 10%, meaning what's called, probably speaking, the shadow banking sector, wealth management products, are also under pressure. So you have some structural problems with demographics, structural problems in the housing market, and you have a cyclical slowdown. And then on top of that, you now also have some issues, as you're mentioning, geopolitically. China is getting more isolated. One can then discuss if that's permanent, temporary, whatever it is, but that's the reality of the world we live in. That's also, of course, having some implications for fewer companies likely doing investments in China. You also have had some regular pendulum swings, if you will, on the regulatory side. So the list of worries about China is growing and continues, therefore, finally, in summary, and this was a very long answer to your question, but in summary, create just a situation where it's becoming very, very complicated for investors and for firms to invest in China. The Secretary of Commerce, Gina Raimondos in the US, she said that China was uninvestable for all these reasons that I just went through. And that's, of course, making you somewhat more worried about, but that might have then some implications, in particular on the Chinese front. India has certainly benefited to some degree from all that. And that's why India, of course, is looking a lot better on a number of different fronts, partly because they don't have the housing bubble, they don't have the geopolitical risk to the same degree, and they certainly don't have the same downward pressure because of exports slowing. So in that sense, India has been benefiting tremendously. And the final statistic here is also, remember, it used to be the case for a long time that US imported more from China. US actually imports now today more from Mexico than they import from China. So that's also telling you that there's a huge redirection of supply chains and manufacturing from China towards both India and also towards Mexico.
And India has very favorable demographics.
Absolutely.
And the other thing that I think they've gotten right in the last few years is that digital infrastructure is absolutely outstanding. They were lucky to have the founder of Infosys in charge of the first phase of the project, and I did a really good job with. So it's amazing when you go to India and you see these street vendors, with QR codes because
no cash.
But no cash.
Yeah.
It is fascinating. But what it's also done, because India's had a huge problem with the underground economies, the moment you get into the official biometric identification and so on, and the payments infrastructure, you then come into the legal economy. So the percentage of people paying tax has gone from minuscule to pretty significant now. So it's really changed sort of, and there's a lot of optimism. But so let me give you a closing question, and then please get your questions ready for Torsten. How do you summarize? What is the my students always ask me, just tell me the 3 things that'll be on the test.
I know.
So I'm like, well, I actually have a stock answer. And so why don't you just pay me? I'll give you an A. My dean's here. I hope he's not.
No.
I don't actually say that, Ian. What does it take, the punchlines? There's a lot for people to digest, and that's why we have people like you, because technology executives have ridiculously busy lives.
Yeah, no. So I would say that the 2 key things on the test, and the main takeaway at the moment is, number 1 is that interest rates are high. And I know that we all walk around, and you and I have talked a lot about this also, that, we have a good idea, and you want to invent something new, you want to invest in something new. And for many years, you didn't have to think about what interest rates were doing. But when interest rates were 0, and there was basically free money, then our idea could easily get implemented. But when interest rates now are 5, 6, 7, or in some cases 8, 9, 10, depending on whether you're high yield or investment grade, it does make an enormous difference. So the first thing to watch is, when are interest rates going to come down? The good news is that Fed Fund futures and markets are expecting the Fed to begin to cut rates in the middle of next year, specifically expectation in markets at the moment is that the Fed will start cutting rates in July of next year. So that's the good news, that this is temporary. So we just have to wait a few more quarters and then things will be fine. But for now, we still have high cost of capital. That's the first absolute number one bullet point on the exam, namely that you need to think really hard about that what are the cost of financing doing and what is your expectation to what they will be doing going forward. The second issue on the list of bullet points is certainly the China issue, namely that if we have slowing growth in China and if we have the slowing growth generally coming around everywhere, that will begin to have also some consequences for the US economic outlook and also for the tech sector. So those two bullet points, the geopoliticals, including if you want to throw in on the second bullet point, a sub-bullet point about Russia, Ukraine, and what's going on elsewhere, that certainly also plays, broadly speaking, a role. But I would say the number one issue by far at the moment, if we take this the same in 12 months' time, it might be some different bullet points, but the number one is absolutely that the cost of capital is unusually high. So that's back to page 1 in your finance textbook. What are the implications if the risk-free rate goes up? And the implications are higher risk-free rate means bad for risky assets, bad for S&P 500, bad for NASDAQ, bad for anyone who wants to take risk, because more money is going to come into the risk-free rate as long as it's so high. So once it comes down again, then we will go back and have a discussion about, well, maybe now cost of capital being lower can generate more risk-taking.
So my last question for Torsten is going to look kind of silly, because when you see the energy that this gentleman has, and my question was going to be, what excites you about what you do every day?
No, it's good.
So the excitement is so obvious, but still I'm going to stick to it.
So, of course, I love my job and talking about inflation, unemployment, and what it means for investing. But other than that, I love soccer. I play soccer every Tuesday evening. So, and I watch the Premier League and have fun with figuring out who will be winning.
I used to be a Bayern Munich fan before I came to the US and lost. When I moved to the US,
well,
there was no coverage.
They did well. They beat Manchester United last week.
But there was no coverage when I came here, so it was like soccer was not a thing here, including Premier League. All right, let's turn on the house lights and let's see if we have some questions from the audience.